Welcome, ladies and gentlemen, to another installment of Thursday Thoughts. I am Alex Leonida. I'm the Chief Market Nerd of Capital Financial Group. Thank you all for joining me again this week. I really appreciate this. I love sharing my information, knowledge, and hopefully we can learn something together. I definitely did learn something this week, and I'm going to share it with you guys in just a minute. If you haven't subscribed yet, make sure you do that so you don't miss any of our videos. If you guys have any questions at all that you would like me to address next week, shoot them over to info@cfgfinancialplanning.com. As always, we're going to cover four big topics this week. Number one, we're going to do important data from the week. Number two, we're going to do big news stories. Then I'm going to answer a question. It's a good one this week, and it's probably pertinent to a lot of you out there. And then we're going to close with a final thought, or as I like to call it, my special rant. So let's get rolling. Let's get into our data points. I know this is a little bit of a slower part of this. I got some feedback on it, and people don't want me to blab too long on the data because most people don't care. But I'm going to go through the same stuff that I normally go through, and we start every single week with the same thing. And if you guys remember, we've been leading off with jobs because it's really important to know what's going on in the jobs market because it gives us a good idea of what to expect from the economy moving forward. So let's get rolling here with our jobless claims numbers. All right, this chart should look familiar at this point. It seems like it's the same story repeating itself each week. A little bit less atrocious on the data, and that is an improvement in rate of change terms. That's something we always talk about. Things getting less bad is good. Something I learned this week is that the data that's actually reported is skewed. Shocker, right? Apparently, the Department of Labor, they have this like new line item on their data release each week that I didn't even notice, and I don't know how I missed this, but it's never in the headline number. It's actually people that are on coronavirus insurance. It's like a different line item in a different section that's not included in the actual headline number. So right now, if you were just to read whatever they're releasing to all the news stations, it'd say, okay, well, we have 20 million people, whatever, unemployed. And we've been talking about how that number's probably worse for the last like month or so. But it's actually more like 30 plus million, and it's on the PDF that they release on page 4, halfway down. It talks about all the people that have filed new claims for coronavirus related work loss. And at the bottom, it actually shows a total, including all the people that are currently on coronavirus work loss insurance or whatever they call it. And it means that we're dealing with over 30 million people unemployed right now as we live and breathe. So pretty crazy, but you learn something new every day. And I just wanted to share that with you guys because I thought it was incredibly interesting and I had never noticed it before. Moving on to our biggest data point of the week is going to be CPI, the Consumer Price Index. Just as a refresher, I know most of you guys know what that is, and we've talked about it in reviews. And if you're not a client, then you may or may not know what it is, but it's just it's a measure of core inflation. Consumables, whatever, stuff that we use every day. What is the cost doing on a month-over-month basis? That's what the CPI is. The drop we've seen over the last 2 months is pretty powerful. I know that this chart is probably kind of convoluted, so let me break it down just a little bit. The midline right there, 0%, that is zero inflation, right? Pretty self-evident. I chose this time frame because I wanted to capture what happened in 2008-2009 period when we had a pretty significant month-over-month drop in inflation for a few months in a row. What we just saw over the last 2 months of 2020 was the most extreme drop we've seen in CPI over to a 2-month period since the Great Recession or the financial crisis or whatever you want to call it. It's just pretty interesting. I mean, from my perspective, it's kind of looking like a bit of a stagflationary environment is starting to set up. And just as a refresher on that one, stagflation is when we start to see inflation rebound, because we saw that little V bottom happen, you start to see inflation rebound and accelerate because of all the money that's being printed or treasuries that are being bought and super easy lending policies from the Federal Reserve, keeping rates super low, et cetera. And then we have really, really slow growth. And I think that's kind of a scenario that all of us could picture right now. I mean, we have 30 million people unemployed. Sure, some of them are going to get their jobs back, but that's a lot of people that aren't going to have excess cash when all of this extra government cheese falls off the books, like we were talking about for the last 3 weeks. What happens when the PPP loans are due, and or when they get forgiven, people get laid off again? What happens when the $600 a week from the federal government gets dumped and all the extra state money that's thrown in, depending on which state you live in? I mean, that's a lot of extra disposable capital that is going to be vaporized in a matter of months. So we're kind of predicting slow growth, right? And increasing inflation because the dollar is going to get weaker as the Fed continues to buy bonds and print money, et cetera. It gets a little more complicated than that, but that is the gist of it. Um, I feel bad. If I would have done like Wednesday thoughts or something like that, I would have been talking about this kind of crazy market setup and this potential stagflation. And then all of a sudden, we were thinking volatility was going to start ramping, and boom, today the market's doing what the market's doing. Um, Along the same lines, actually, I want to touch on how stretched the U.S. market looks right now from a fundamental perspective, and I think the timing is probably really good to dig into a little bit of this stuff. You guys know that I normally avoid talking about the stock market and valuations and stuff, but I think right now this is timely considering the drop we saw in U.S. markets today. All right, so I'm going to do something just a little bit different. Instead of talking about, PE ratios, whatever, like people do on TV most of the time, this is YouTube, so I can talk about whatever I want. And I'm going to talk about the cyclically adjusted price to earnings ratio, or the CAPE ratio. Um, so we're currently at levels right now on this blue line that we haven't actually seen since 2000 and I was going to say 2008, but we're actually higher than where we were in 2008. We haven't seen levels like this since the tech bubble. I mean, if you could, I should have drawn a line on this, my bad. But if you can go back to late 99, that's kind of where we're at. Now, obviously, things got a little bit out of control when people started buying random website stocks that just start trading for no reason whatsoever. I mean, so that was a little bit nuts. But from my perspective right now, we're about as expensive of a market as we've ever been. We actually peaked on the CAPE ratio for this cycle back in November, December of last year. And it's starting to set up. As you can see, there's a rollover happening here. And the only way that we get out of this trend is to see things become less expensive. And the way that works on a relative basis is companies need to come out and crush their earnings numbers and just print money, right? Because that obviously brings that number down a little bit, that blue line that we were just talking about. Or we need to see prices come down. I mean, one of the two things, they got to move in order for this to look a little bit normalized. With unemployment the way it is right now, I don't see how that's going to happen in the short term. And this actually kind of dovetails into something else that I'm going to talk about in just a couple of minutes in the big news section. But I really wanted to point out how important that was, and we'll actually go back to that chart because we're seeing this huge peak and this huge rebound in the S&P 500, for example. That's what I used on this chart, and this all coincides very, very similarly to what we saw with inflation data in 2000 and 2008. Starting to roll over poorly, and then also the highly elevated CAPE ratio being high like this. I know I'm talking a lot of financial jargon right now, but bear with me. When you see this is generally a precursor to a second leg down in the market. It doesn't mean we're going to create new lows. It just means there's going to be more volatility moving forward. There's no way we're going to get around that with this type of fundamental setup. I mean, I guess if the government gives us another 3 trillion, it could delay things a little bit, but everything comes home to roost eventually. That is what we learn when we study macroeconomics and long-term economic trends. So let's jump into the big news section. I told you I was going to keep that a little quicker today. Let's do the big news. There wasn't a ton of huge news this week that was, I guess, out out of the scope of all the protests and all the stuff going on with the police. But we start every week with the same thing. We just do an update real quick on coronavirus, and this chart's beginning to look familiar, I'm sure. And last week we were actually talking about a better trend. We had lower highs and lower lows starting to emerge, and that's really important. And I'm just referencing this top chart specifically because that means that there is a positive trend, and that's actually the curve rolling over like everybody was hoping it would. The last few days have actually broken that trend, and you can see that in the last couple of data points here. We had a new spike to the upside, which was a higher high going all the way back to middle of May, actually. And then we also have a higher low because there seems to be a little bit of a up and down movement to these charts. You want to see new lows being made, right? And we had a higher low. So this could very well be a trend reversal. And we actually talked about this over the last couple of weeks, that the incubation period on this virus is, I don't know, 10 to 14 days. I'm not a doctor, but that seems to be what's in the news right now. And the state started reopening about 2 weeks ago. More states are opening, getting to phase 2 or whatever. I don't really understand the whole thing because they were supposed to close back down if case numbers spiked, and they're not, and whatever. But this is the data that we were waiting on and that we were talking about. Most of the governors seem to be balking at going on lockdown again. So we'll have to see if this metastasizes into something worse. Obviously, there could be issues with all these protests that have been going on. Totally understand why they're happening, but there could be a scenario where there are super spreaders. I don't really know. We're going to have to wait probably another 2 weeks to get the full brunt of the data on that to see if there's a bunch of new cases in these particular urban areas and places where there were massive protests. I mean, there was like 100,000 people in Philadelphia or something. So that's going to be really interesting. There's not a lot of social distancing happening, and I guess some people wearing masks, most people not. I don't really know. But I did want to point that out because it's going to be interesting to see how this trends moving forward and what that means to the economy. Next up, if you saw Monday Morning Minute, we talked about how the Fed was gonna speak. Normally not too particularly exciting, other than Jay Powell saying that this recovery is going to take a long time. Whoa, thanks, buddy. I'm pretty sure everybody thought we were just going to get back to business as usual like tomorrow, but he's saying it's going to take a really long time, even out into late 2021. There's a little bit of new information in this one, not a ton. They did give some guidance on bond buying, and basically what they're saying right now is they're committing to buy another 80 billion in treasuries per month and another 40 billion in mortgage-backed securities per month. That's, whatever that means, but that's good in terms of mortgages. Just as the fact that they also reiterated they're going to keep rates at zero, the Fed funds rate at least. That's that 0 to 0.25% spread that they've been floating in for the last few months. They're going to keep them there, so mortgage rates should stay depressed, which should at least buoy the home market, the home buying market just a little bit, which is good because people like cheap mortgages. One of the other things that I thought that was super interesting, well, I shouldn't say one of the other things, it's the only thing I thought was super interesting, is that Jay Powell said he was going to start, or at least consider starting, yield curve controls. If you don't know what that means, I certainly don't blame you, and you shouldn't feel bad because realistically, we haven't seen the Fed manipulate the yield curve since World War II. Basically what happened is the US had to buy a bunch of stuff to fund the war effort, right? Like they had to build tanks and planes and whatever, like lots of money. It didn't exist. So the Fed jumped in and just bought gazillions of dollars for back then worth of treasuries to create cash that the government could then spend. That was our first spike in the corporate deficit, or not the corporate deficit, the US deficit, excuse me. So pretty interesting to see how this works. I'm not sure if they're actually going to follow through with it. It's really weird. I mean, theoretically, this could mean infinite treasury buying, which is really, really weird to think about. But I mean, frankly, nothing would surprise me these days. Next up on the list is probably the biggest piece of news of the whole week. Dun, dun, dun. We're in a recession. Yeah, I actually chose this slide because I feel like most of us probably knew we were in a recession, but CNBC didn't. They ran this whole spiel on how bear markets don't necessarily lead to recessions, yada yada yada. They did this actually back on March 10th, and they said we probably wouldn't go into a recession just because of COVID. Well, yeah, that's interesting, right? Sorry, I don't mean to be rude, but that's just ridiculous. That's the whole thing when I talk about you watch too much of this news, you end up in a situation, specifically business news like this, like it's just always bullish and they're always like a step behind, etc. I mean, they got to have stuff to talk about, but it's not my cup of tea. The National Bureau of Economic Research actually made it official today, or not today. It was actually Monday that they released it that we are in a recession. For the sake of making this a little more interesting, we technically we technically hit a peak uh, back in February in terms of productivity in GDP. Um, I actually pulled this chart up again just because I wanted to show those little peaks that happened right before the fall when we started to go on lockdowns. But what's different about this chart this time is I threw these grayscale pieces that actually signify when recessions occur. And when you see the rollover in the CAPE ratio and the rollover in the market, yes, there's always some kind of bear market bounces, et cetera. But I'm not sure where CNBC was getting their data because every time you see a huge rollover in the CAPE ratio, you see a gray bar. I have no idea how long this one's going to last. A lot of it is going to be driven by, if we can get into a position where we have a vaccine, et cetera, where people are a little more comfortable. I mean, a lot of people I'm talking to are feeling a lot more confident about things, but we're seeing these huge case spikes that we were talking about. So we'll have to see what this second wave looks like. It could have just been an anomaly, right? It's a small data set so far. So we're just going to keep tracking that and keeping you guys updated on that. So moving into the question section, we have a pretty good one this week, and it's actually something that I thought about the other day. And I had a perplexed client pose the question to me today, and it reads something like this. I haven't been driving much, so I haven't had to fill up my car in a few weeks. I was shocked to see gas prices nearly $1 per gallon higher than last time I filled up. How is this possible when you were talking about negative oil prices a few weeks ago? So, really good question. First of all, oil prices went negative because we had a storage crisis and speculators weren't able to take delivery of the futures contracts that they were holding. Um, just a little reminder, that's the whole thing. Like, hey, I have a futures contract expiring. You're going to deliver how many barrels of oil to my front porch? I'm going to pay people to buy these things for me, essentially. Like I'm gonna pay them just to take it because they have places they can put it because I can't put it in my garage, right? So that's what created that weird anomaly in oil prices. Um, but the question, even beyond that, the question is still a good one, and the answer is relatively simple. It all falls into supply and demand, right? So production has been cut globally quite a bit, and more specifically here in the United States, we've shuttered more than 50% of our rigs. So we've drastically reduced the amount of oil production that we're doing right now. Um, and then we also have seen over the last couple of weeks with states reopening, we're seeing a rapid increase in travel again, which is increasing driving across the board, which means more gas fill ups, more consumption, right? So, I mean, it's tough. Well, I think the run up in oil prices over the last few weeks is a little bit overdone. It's not incredibly surprising to see prices much higher on a daily basis in terms of gasoline when daily production is cut by 50% ish, and then consumption increases dramatically. So it's probably a little more fairly valued now than it was at like zero, right? That would make sense. Oil shouldn't be free theoretically. But I think it's probably a little overdone, and we could continue to see some pressure in the oil market. So we might get a little bit more relief at the pump, depending on what happens with states reopening over the next few weeks. All right, cool. Last one is my final thought. There it is. Final thought. This is my favorite part, for sure. No doubt about it. Um, All right. So I know that I picked on state governors a few weeks ago for their inability to come up with a consistent state reopening plan, and there was no continuity. Nobody had a clue what was going on. Um, but I actually have another bone to pick with these folks. But I'm going to start this little segment off with a question. Okay. Have you ever thought about spending money you don't have? I mean, it's kind of a rhetorical question because the answer to that is yes. I mean, we buy cars with long-term financing, right? So we're spending money we don't have. Um, you know, I mean, we're Americans, right? So I'll run a segment on credit card debt and consumer debt at some point, but people like to buy things on credit cards and then not pay them off every month. I mean, that's pretty common. But like, let's look at this from a different perspective. Let's say we live in some kind of alternate reality that lets you spend money that you don't have, or you don't have the credit available to spend, with the assumption that someone else might pay off your debt for you, all hopefully before. Okay, think about that for a second. Would you do it? I wouldn't. That's just me. I would not do that. Um, but I do know who is doing that, and it's the governments of California, Illinois, New York, among a couple other ones. They have some interesting stuff going on right now. They're they're kind of in this situation where they're putting together massive spending packages, like billions on billions on billions of dollars, with no income to offset the packages and zero intention of issuing any muni bonds or anything else to try to fund it. Okay. Um, if that sounds weird to you, it should, because it's pretty crazy. They have no idea what's going to happen in the future. But the bottom line is they're literally going to spend money that doesn't exist in any universe on a bunch of projects. Um, they're oh, actually, let me digress here. This is pretty funny. And beyond that, they're actually expecting to make their financial situation look so atrocious that the federal government is going to be forced to bail them out. They're going to make their balance sheet such a dumpster fire that the federal government's going to have to write checks so these states don't default on everything. I mean, it's going to be to the point where they're actually funding, I don't know, their food stamp packages with money that doesn't exist, expecting bailouts. And then on top of that, they're going to go build highways and bridges and high speed rail and all of this shenanigans that makes absolutely no sense to anybody if you don't have any money to pay for it. But they're going to make their balance sheets look so bad that the federal government has to pay for everything. I mean, I don't know how we got here. Truly, I didn't learn about any of these shenanigans in my econ books. I didn't learn about any of this stuff in any of my history books. I mean, I was a history minor also. I mean, I'm obsessed with learning about the way things had been done in the past, what happened, etc. I've never seen anything like this by any stretch of the imagination. I couldn't even have guessed that this would be a strategy to make your balance sheet look so atrocious that the government has to pay for it. There's essentially no playbook for fiscal gamesmanship like this. Like, it doesn't exist. I mean, I hope it all works out, but I also hope I'm not stuck footing the bill for this whole thing with super high tax rates, trying to bail out people in Illinois who just got a new 10-lane highway. What is that? Um, I don't know. We're going to continue to monitor the situation. I'm going to stay on top of this one and give you guys updates. Realistically, we're already looking at this as a potential issue from a portfolio management perspective. So we're on top of it. We're ready for it. I don't know what's going to happen, but all we can do in this particular instance, even though hope is not an investment strategy, hope can be a strategy to, I don't know, pray for state governments not to make reckless decisions with taxpayer money that they don't have. I don't know. That's my rant. That's all I got for you this week. As always, thank you guys so much for watching. I really appreciate it. I love the opportunity to share my thoughts with you guys every single week, and I hope you got something out of it. I do a lot of research for these, so if you have any ideas for me or want me to talk about anything specific, shoot it over to info@cfgfinancialplanning.com. And remember, like and subscribe right down here under the cool little hand here. And cheers, guys. Also, this week, this is Japanese whiskey, since our Federal Reserve is starting to act like the Bank of Japan with their crazy bond buying. So, trying to stay on topic, you know? Appreciate it, guys. Have a great weekend.